So over here for this session over here, by the end of today's presentation, there are a couple of things that we'll be covering. So first up over here is to understand the concept of what we call context in trading. And then from there, we'll talk about how we're able to then identify patterns with context to help us increase our probability, because not all patterns are equal in quality, right? Some of them are higher probability. Some of those patterns, depending on where they are developing, which is based on context, you might want to even avoid or even skip some of those patterns, right? Or those setups that you see. Lastly, we're going to cover how to forecast and prepare for the week as well, right? Using some of the principles over here, as well as understanding the concept in context. So what is contextual trading? This is something that, of course, you need to build up from the strategy itself. This by itself is not a strategy, it's not a standalone strategy, but contextual trading essentially is about you having a strategy and then you add elements into it to help you fine tune it. So what exactly is context, right? Context over here is kind of like categorizing a setup, categorizing a trade opportunity into different quality. So over here for me, I kind of have three categories whenever I look at a setup. The first one over here is high probability, quote unquote, what we call take it all the time kind of setup, which means that whenever you identify a trade opportunity, a setup that falls under this category, you don't want to think too much about it. Just assess your risk, put in the lot size, manage your risk, and then you take that trade, because these are what we call the take it all the time kind of trade, right? And you don't want to get overly worried about it. You don't want to overanalyze it, because based on the context, based on the setup itself, these trades are the ones that are able to give you the big winners, right? And that's where I categorize them as just take it all the time. And then there's the other category, which is what we call an acceptable, decent trade, which means that it's not too bad. These are trades that you can actually take and they're acceptable, right? So they actually also falls under the part where it fulfills all the criteria and condition based on your strategy, based on your trading plan. So these are what we call not too bad, right? You just decide, whether you would like to take it or not. And last but not least, I do have this, what we call a valid but short-term trade. Why I have this category is because I'm more of a swing style trader. So we're looking at bigger move in the market, right? So sometimes certain trade setups and opportunity may be more of a short-term trade. So maybe, within a correction, within a bigger corrective structure, we might still have some decent opportunity. So these are what we call valid but short-term, which means that if you don't have the time to manage this kind of trade, then you would rather avoid it, because they need a little bit more of an active management, right? Because they are short-term, the trade can play out pretty quickly. You want to manage it as much as you can to prevent it from being a winner turning into a loser. So for me, I have this kind of categories. Of course, these are not like fixed where you just can use these three categories, but I just want to give you the idea that context over here essentially is to allow you to have this clarity in terms of like, how do you rate your trading setup? How do you rate a trade opportunity? So the idea of this is when you see a great AAA kind of trade, right, which to me is the take it all the time setup, you don't want to think too much. You just execute it according to your risk management. And if you spot like for example, for me, right, if I spot a valid but short-term trade, I would really consider whether I want to take it. And let's say, that week, that period of time, there isn't much of a trade at all, right? And I spotted a valid but short-term trade, then maybe I can spend more time to actively trade it and manage that. But if let's say during that same period of time, during that week, I have some acceptable, decent trade, I have a high probability trade, and I also have a valid but short-term setup, what I would do is I would definitely avoid and ignore, in a way, the short-term trade, and then focus on the higher probability trade, right? So that's the idea of it. So give you that kind of clarity on what kind of grading the setup really is. So that's what contextual trading enables you to do. So over here, when we talk about context, just like I mentioned, right, you need to already have what we call a strategy in mind. You need to have a setup in mind, right? So this is going back to what strategy you're using, what trading plan you're using. The idea of it is, as I mentioned, not all patterns are the same. They may look the same, but depending on where they are developing, where this pattern appears, the quality of it is very different. So for example, we use a lot of the flag setup, which is the impulse plus correction, as well as the crawl or diagonal setup. But this similar setup can again be categorized under the quality A, trade it all the time. It can also be categorized as a decent trade and also probably a short-term trade. Really depends on where it happens. So this location that we're talking about, this context we're talking about, is where you need to look beyond just this pattern, right? You want to look at a bigger scheme of things where this pattern is developing, right? Is it developing near a previous support, near a previous resistance? Is it just developing in no man's land, which means we're in a range-bound environment and then you saw this pattern happening right in the middle of the range? So it can give you certain idea whether you have that kind of conviction to that trade, right? So again, back to context. So give you some examples of how it looks like, right? So over here, you can see this is a 1 hour time frame chart, and we do have a valid trade, right? So over here, you can see we have an impulse move to the downside. Following that, we have a correction. So this is basically our setup. And this setup is suggesting that the probability of the direction is down. It's a higher chance that the market will continue to move lower. However, we can also, very obvious from this particular scale, see that we have a significant bottom where the market actually tested it once, 2, 3, 4 times. And that essentially becomes a key level. So when we are thinking about shorting this or selling this particular trade, we need to be very aware that market, when it comes down, potentially it may bounce at this key level. And then we need to then assess, what is the profit potential? How much room can price actually hit lower before it's going to hit that key level and maybe react or even bounce out of it? So when you look at this, the current market price, if you look at the right-hand side, is about 0.6135 in this case. And then the key level is about 0.6085, right? So that's a good maybe about 50 pips. Now, from a swing trade perspective, 50 pips is not something that is very exciting. But of course, if you put that in the perspective of a day trade, a intraday kind of setup, then yes, 50 pips is quite significant. But for me as a swing trader, this is what we consider as a short-term trade. It's valid. The probability is definitely still there. But of course, we're targeting a 50 pips trade, which means it can happen maybe well within a day or two. And naturally, it means that you need to be more active in managing it. So if I don't have the time for that particular period, or let's say, I have a better setup, then these are the trades that I'll probably want to avoid. But if let's say same situation, but there's no setup for me, there's no other trades, I'm pretty free on that day, then these are the trade setups that I might consider taking to kind of capitalize and take advantage of that short term. So that's the idea of it. Another example. Now over here, we have a slightly different setup, right? This setup here is called a crawl or a diagonal setup. It's a valid setup. It's a setup that will look to sell because a crawl and a diagonal is actually a reversal pattern. So this one here suggests there's a high chance this will probably reverse and come down a little bit more. But again, look at it. Where is this pattern developing, right? This pattern is essentially just developing very near the previous significant support, which is around 0.6085. Now, if I'm going to sell this, the profit potential, again, to capitalize on it is about 50 pips. And this is, again, where I categorize this as a valid but short-term sell trade. So again, back to the part where if I have a better ones, I will probably skip this. So that's where you need to be having that clarity in terms of what kind of quality this setup really is to you in your trading plan. And the way to do it is to add in the element of context, right? And ask this question to guide you. Where is this setup? Where is this pattern developing? Is it near a significant high or significant low? Is there some very obvious kind of support resistance that you need to take note of? More example over here, you can see this is a setup where we're looking to buy because we have an impulse push to the upside. Following that, we have a correction. So this is a flag pattern, right? It's a setup that we look for a buy trade. But ask yourself this question again, right? In context-wise, where is this setup developing? So we realize that this pattern is essentially developing a no man's land, right? You can see here we have significant high, we have significant low. This pattern is right smack in the middle of it. So of course, if you're looking to buy, then we need to be very, very aware of the previous key high here because the market may bounce off it, which means that our immediate profit potential will be somewhere around this high. So if you take a look at this here, We have price currently trading around 1.3550 or 1.3540, and then the high there, the target that we're looking at is about 1.3750. So it's about 200 pips. So 200 pips for a swing trade, not too bad, right? It's definitely not really a short-term thing, but this is not a just take it kind of trade, because when we talk about just take it kind of trade, we are talking about really, really big moves. So this one here is what we call a second category. It's a pretty decent trade. So these are trades that occur most of the time in my setup, in my trading plan. And these are a trade that I would spend a little bit more time to really look at it and even execute it. So you can see the difference, right? From this versus the previous two example, which is valid but short term. Okay, so that's all from me. All the best to trading, and we'll see you guys next week. So see you. Bye-bye.